What's going on, everyone? This is Obi with Courtside Financial. Today is November 13th, 2025, and today we're coming at you with a loaded episode. Nio just announced that they are releasing their Q3 earnings on November 25th, which is less than 2 weeks away, and all eyes are on one question: can they deliver their first ever quarterly profit? But while everyone's focused on Nio's Q3 earnings call, there's a crisis brewing that no one's abreast to. XPeng's owner He Xiaopeng just admitted that he's been having drinks with battery bosses in the industry. Why? Because automakers are literally scrapping, begging, and standing outside of CATL's headquarters trying to secure their battery supply. And it gets even better. Nio just announced the first Swedish swap station just got approved for grid regulation, turning battery swap stations into actual revenue generating assets. So today we're talking about three stories that paint a complete picture of Nio's path to profitability, the battery supply chain crisis, and how Nio Energy might be the dark horse that no one's pricing in. Let's get into it, guys, because this is Courtside Financial. All right, let's start with the headline. Nio will announce their Q3 earnings on November 25th at 7 a.m. Eastern Time. But what's this call really about? It's about, can Nio deliver on CEO William Lee's promise of Q4 profitability? Now, he's been doubling down on this over the months, over the weeks. He's been reassuring everyone that they will hit Q4 profitability. So will we see that is the question. Q3 deliveries were 87,071 vehicles. That's within their guidance of 87,000 to 91,000 vehicles. Of course, it's closer to the lower end, but year-over-year growth is 40.77%, with quarter-over-quarter at 20.84%, which is good. Revenue guidance for Q3 is between 21.8 billion rand to 22.88 billion rand. That's 16.8% to 22.5% year-over-year growth. Now, here's where it gets interesting, though, guys. The brand split. Nio, the main brand, 36,928 vehicles in Q3. That's down 39.49% year-over-year and down 21.65% quarter-over-quarter. So the main brand is bleeding. Anvo, 37.656 vehicles in Q3, up 120.46% from Q2. This is the first quarter where Anvo outsold Nio, the main brand. Firefly, 12,487 vehicles in Q3, up 59.21% from Q2. So Nio Inc. as a whole is growing, but it's 100% driven by the mass market brands Anvo and Firefly. The premium brand Nio is declining. That's a mixed signal for margin. Now let's talk Q4, the profit quarter. Nio guided 150,000 vehicles for Q4. That's about 50,000 vehicles per month. They delivered 40,397 vehicles in October. That's a record, but it's still about 9,600 vehicles short of where they need to be to get to that 50K target. If they hit 150,000 vehicles in Q4, that's a 72.3% increase from Q3's 87,071. So that would be massive sequential growth. And remember, William Lee said Q4 has no new model launches, no events like Nio Day, meaning major capex is all done. It's just about execution and margin. Here's my take on what to watch for in the Q3 earnings call. Gross margin trajectory. Did Firefly and Anvo improve margins in Q3, or are they still diluted? Operating expense decline. Did expenses actually decline or stay flat in Q3? Or was this just talk? Q4 delivery confidence. Do they stay confident? Do they reiterate, or do they revise down? The cash burn rate, is it still $500 million per quarter, or is it starting to fizzle out or level out? Battery as a service penetration. What percentage or how many customers are choosing battery as a service? That's recurring revenue for the company. The market wants to see profitability, not promises. Proof. Q3 results will show whether Q4 is realistic or aspirational. Okay, so now let's talk about the elephant in the room, or should I say the shortage in supply chain. November 6, 2025, He Xiaopeng admits in an interview with Daily Economic News, "I've had drinks with all of the bosses of our battery manufacturers in the last week or two." Translation, he's begging for battery supply. And it's not just XPeng. According to reports, purchasing personnel from multiple Chinese automakers gathered at CATL headquarters trying to block the door to secure battery production capacity. Let me repeat that. Automakers are camping outside CATL's sales office like it's a Supreme drop or an iPhone launch. This is unprecedented. So why is this happening? Well, there's three reasons. Reason number one is that there's the purchase tax cliff. Starting January 1st, 2026, the purchase tax exemption for EVs gets cut in half, and it's going to be capped at 15,000 Ren. Right now, it's fully exempt, so consumers are rushing to buy before year end, and automakers are scrambling to deliver every possible unit in 2025 to capture demand. From January to October 25th, China produced 13 million new energy vehicles, up 30% year over year. In October alone, new energy vehicle sales exceeded 50% of total vehicle sales for the first time ever. So the market is on fire. Reason number two is that storage is stealing supply. Here's the plot twist that most people miss. The energy storage market is booming and creating a reverse siphon effect on the automotive batteries. In Q3 2025, China's energy storage lithium battery shipments hit 165 gigawatt hours, up 65% year over year. For the full year, estimates are 580 gigawatt hours. That's a 67% increase. Energy storage uses lithium iron phosphate batteries, the same chemistry used in mass market EVs like Envo, Firefly, BYD, Tesla's standard range models, etc. And here's the kicker. Energy storage projects have faster cash flow cycles than automotive. So battery manufacturers are prioritizing energy storage orders over automotive, especially for large format cells like 280AH or 300AH. Battery companies follow a T+3 procurement model. They lock in materials 3 months ahead. Mid-2025, they ramped up LFP for energy storage based on demand. So as a consequence, now automotive is getting squeezed. Reason number three is high nickel batteries for premium models. The shortage isn't uniform. It's concentrated in high nickel ternary batteries, NCM or NCA, used in premium long-range electric vehicles. Think about the Nio ET7, ES8, XPeng G9, Li Auto L series. High nickel batteries require pure nickel sulfate and lithium hydroxide, and international raw material price fluctuations plus long safety verification cycles have created a supply bottleneck. So premium automakers double pressure. LFP shortage for mass market models and high nickel shortage for flagship models. So what does it mean for Nio? Well, here's where things get a little bit nuanced. Nio's main brand uses high nickel batteries for 100 kilowatt hours and 150 kilowatt hour packs. If they can't source enough, Q4 deliveries of ET7, ES8, EC6 could be constrained. Envo L60 uses LFP batteries. If energy storage is stealing LFP supply, Envo's ramp would slow down just as they're gaining momentum. Firefly uses LFP from Songwuda, not CATL, but if CATL is prioritizing energy storage, Songwuda might be facing the same pressure. The good news is that Nio has direct relationships with multiple suppliers, not just CATL. XPT, Nio's in-house power motor division, likely has long-term supply agreements. But the bad news, industry-wide shortages don't care about relationships. If Nio misses their 150,000 Q4 target, not because of demand, but because of battery supply, that's a profitability killer. Because fixed costs don't scale down. You still have the factories, the staff, the R&D. Revenue is what drives gross profit. My take is that the battery crisis is a bigger story than most people think it is. It could be the difference between Nio hitting Q4 profitability or missing it, not because of execution failure, but because of supply chain constraints. And these are things that are beyond their control. Now let's talk about the story that got buried under the earnings announcement. Nio's battery swap stations in Sweden just got approved for grid frequency regulation. On November 11th, Sweden's national grid operator officially approved Nio swap stations to join Sweden's FCRD frequency regulation system. Here's what that means in plain English. Nio swap stations can now act as energy storage facilities that help balance the power grid during peak demand. Here's how it works. Swap stations are full of charged batteries, usually 13 to 20 plus batteries per station depending on generation. During peak hours like 2 a.m., they charge batteries using cheap electricity. During peak hours, like 6 p.m. when everyone's home cooking dinner, the grid is stressed. Nio stations can either withhold charging or discharge power back into the grid. The grid operator pays Nio for this service, essentially renting the battery capacity as grid stabilization. So according to Shen Fei, former head of Nio Power, now Envo president, each station participating in frequency regulation generates tens of thousands of euros in annual revenue. Let's do the math. Nio operates 60 swap stations in Europe, including 8 in Sweden. If tens of thousands of euros means 20 to 50,000 euros per year, that's potentially 1.2 million to 3 million annually just from Sweden's station. Now scale that. Nio has 3,563 swap stations in China. If even 25 participate in grid regulation at 100,000 ren to 200,000 ren per station annually, that's 89 million to 178 million ren. Approximately 12.5 million to 25 million US dollars in pure ancillary revenue. That's not enough to move the profitability needle on its own, but combined with battery as a service subscription revenue, charging fees, swap service fees, energy arbitrage, buying off peak, selling peak, grid regulation payments, Nio Power could become profitable, a profitable business unit on its own. And here's the strategic brilliance. This only works if you have a dense network of stations with high battery inventory. Tesla superchargers can't do this. They're just chargers, not storage. CATL swap stations could do this, but they're years behind on deployment. Nio's first mover advantage in battery swapping is starting to compound in ways the market hasn't priced in yet. One caveat is that Nio's sole swap station in Denmark was supposedly providing frequency regulation services starting February 2024, but according to a local user, that station has since shut down. So there are operational risk and regulatory complexities in different markets. But Sweden's approval is huge because it's a full nation grid operator endorsement, not some pilot program. Let me tie this all together because these aren't random headlines. These are all pieces of a cohesive puzzle. Piece 1, Nio reports Q3 earnings on November 25th with Q4 profitability on the line. The brand mix is shifting heavily towards Envo and Firefly, which is more mass market, which is good for volume, of course, but challenging for margins. Piece 2, the entire Chinese auto industry is facing a battery supply crisis driven by purchase tax policy, energy storage demand, and high nickel shortages. This could cap Q4 deliveries across the board, not just for Nio. Piece 3, Nio swap stations are being approved for grid regulation in international markets, creating a new revenue stream that compounds the strategic value of the swap network. So here's my short, concise thesis. Nio's profitability in Q4, it all boils down to 3 things: volume, margin, and OPEX. The battery supply chain crisis is the biggest risk to number 1. But here's the biggest counter narrative. If Nio does hit 150,000 vehicles delivered in Q4 despite the shortage, that means they successfully navigated supply chain hell while competitors fail. That's a competitive advantage that proves operational excellence. That's it for this episode of the Courtside Financial Podcast. My name's Obi. Thank you for tuning in. I am now signing off. Make sure you hit the like button. Make sure you hit the notification bell icon. Leave a comment down below. Share the video. And definitely hit that subscribe button. I'll see you in the next episode. Thanks for watching.